Today's topic, I want to discuss an IUL plan for retirement. So an IUL, Index Universal Life 7702 plan, they're all essentially the same thing, just different marketing terminology. So with this video, I want to uncover the 5 most important areas when trying to look for an IUL plan for your specific situation and whether or not to use it for retirement, making sure that you're avoiding the 5 most common mistakes. So first off, how does an IUL account work for retirement? And in its most simplistic form, what an individual is trying to do is they're trying to set aside monies, whether on a monthly basis, annual basis, trying to leverage lump sum dollars, and they're trying to hoard it within a cash value of a life insurance policy, making sure that they're stripping away the most amount of costs, so the most amount of dollars go into this plan, and then they're trying to have the highest possible growth and leverage the power of compound interest and all the tax benefits with that this cash value generates. So when we fast forward, if somebody's doing this on a consistent basis or they're hoarding X amount of dollars into this sort of plan, when you fast forward and you're trying to leverage this for retirement dollars, your cash value could ultimately grow tax-free. You could pull your monies out tax-free, meaning more income that you could net in your pocket. And then you'll also have this supplementary death benefit component that's being set up with the plan. So that obviously sounds great. In reality, 9 times out of 10, these sorts of plans are set up the wrong way, and you should be avoiding the most common mistakes. So for starters, the number one most common mistake is choosing the wrong company. When an individual chooses the wrong company, that could result in poor customer service. So like anytime that you want to have some sort of servicing done to your plan and either add further premiums or start taking distributions, taking monies in the form of withdrawals or 1035 exchanges or taking in the form of loans, all these little features make a huge impact when it comes to growing your account and then also pulling distributions out of your account. You also, most importantly, want to make sure it's a well-rated carrier. So not some sort of fly-by-night, not some sort of B-plus rated carrier, something that actually has good financials, they have a good track record, they've been around for a long time. And then lastly, you want to make sure that this company is not notorious for changing rates. And what I mean by that is you might have a carrier that has a high cap rate. But then after somebody's been placed into this plan, 1 year, 2 years down the road, they significantly drop that cap rate. So now that individual is basically handcuffed to that longer term sort of product and they can't really get out. If they get out, then they could be penalized. If they stay in there, they're not really going to have any sort of growth within that sort of account. So it could be a very sticky situation. So just make sure that whenever you're trying to find out the best companies available, always look for which ones have the best ratings, which ones have the best customer service, and then which ones are not notorious for changing their rates after somebody's already set up in their plan. The second most common mistake is choosing the wrong product. Now, when there's kind of a couple different layers to choosing the wrong product. You might have one insurance carrier that offers multiple types of IUL plans. What makes a good IUL versus a bad IUL? And it depends on what that individual's goal is. So if you're trying to utilize an IUL for retirement, the death benefit and all the different costs associated with that death benefit should be the least of importance, meaning that you want to reduce the size of it to make sure that you could hoard as many dollars into this sort of plan. So if you have your options of company XYZ and they're offering 3 separate IUL plans and one has a guaranteed element to it, the other one has certain limitations to it with high death benefit related costs, and then the other one's very flexible, you want to go with the one that has the most flexibility that could give you the highest growth. Really the whole purpose of leveraging this sort of account. So you have something known as net amount at risk that each insurance carrier is going to provide. And that net amount at risk is the risk to the insurance company. And that's ultimately going to translate to the cost of insurance or the cost that's placed within this sort of plan. So some carriers may have certain mechanisms when it comes to reducing that risk. Maybe that means instead of paying a death benefit out in the form of a lump sum, which is a higher risk to that insurance company, they pay it out in the form of annuitization, meaning, out of 5 separate payments or 10 separate payments or 30 separate payments, something that could reduce the amount of risk to them to therefore translate to less cost and less pressure on growing your type of account. The second aspect is limited indexes. So if you have one sort of product line with a carrier that gives you options of 5 different indexes, is that better than leveraging a different product line that might give you 10 different options for indexes, so that if the markets are ebbing and flowing in a certain direction, you could take advantage off of, what sort of sector is going to be most appropriate, as opposed to going into something that is very limited on those index related options and really limited on those cap options or uncapped indexing related strategies. And then lastly is the loan options available. So whenever somebody's looking to pull out monies from an IUL plan for retirement, they could do it in the form of withdrawals. They could do it in the form of leveraging 1035 exchanges, meaning that they're taking their monies, they're 1035 exchanging into a non-qualified annuity and then triggering income from it. Or the most common way to keep it within a tax-free status is by leveraging loan-related options. So you have three main areas on how you could take loans from a policy. You could do it in the form of variable loans, index loans, and fixed-related loans. If when push comes to shove and it comes time that you're going to start pulling monies out and you're restricted with how you can pull those monies out, that could obviously be a bad thing. So that's why choosing the correct product is crucial, and making sure that you're tailoring it within those three main steps, avoiding the highest costs, make sure that you're leaving yourself with the most plentiful indexing options, and then also the most favorable loan-related options as well. The third most common mistake is leveraging a product that has limited indexes. So what I mean by that is typically you'll have these carriers that will offer an S&P 500 index, and that might be appropriate. Or you might have another carrier that's offering the S&P 500 and then also 15 other indices. Some of those indices could be related to algorithmic components that are uncapped, that have certain volatility metrics to it, that have historically fared well. So by giving yourself the most eggs in your basket to choose, the most options, the most eggs in your basket to choose, that's going to typically be the most favorable route. You also want to make sure it's not just a bunch of indexes and then they have low caps associated with it. You want to look at what the fixed rate is. You want to look at what their S&P 500 cap rate is. And then you want to look at what their participation rates if you have some sort of uncapped indexes within that sort of account. So anything, and really the main reason why this is important is because you want to try to accentuate the growth. If you're limited, if you have cap limits of 5% and the markets are performing 10, 20% per year, that's obviously a problem because you're going to be limited on that cap limit, on that cap rate. So most important to just really look underneath the hood, compare and contrast versus some of the other carriers to make sure, okay, this product line, it's giving me all these different features. It's allowing me to hoard the most amount of dollars in there and then also allow me to have the most amount of growth within this sort of plan because it's not limiting what these indexing strategies are available. The number 4 most common mistake is not funding it properly and not structuring it properly. So what I mean by that is individuals, when I see just complete disasters with IUL related plans, is they're trying to minimally fund this sort of plan. So they're either putting too small contributions into this plan because they don't understand how it truly works. They have very high death benefits because they're looking at the overall 30,000 foot view of, oh, it's going to give me some tax-free growth. I'll be able to pull my monies out tax-free, and I'll also be able to leave a tax-free death benefit to loved ones. That's more of a jack of all trades type product. What you want to do is, if you're going to stick to the IUL lane for max cash value, you want to create it, you want to structure it with a max cash value premise. That means smallest cost, smallest death benefit, and you're hoarding the most amount of dollars in there possible. Also, you do not want to pull monies out too quickly from these plans. That's a huge mistake. Individuals may have seen a video online, may have read a really quick teaser that says, oh, I could add my monies into this plan and then start borrowing against this sort of plan within a couple of years to purchase for a car or purchase for a house. First off, the math has to add up. You can't just put in a couple of dollars here and there and hope that it's going to result in hundreds of thousands of dollars of some sort of growth within this account. You have to be reasonable with what you're placing in there, and the easiest way to do this is to really budget the dollars in there properly. So you could have scenarios where somebody's looking for an additional mechanism, an additional savings component, and saying, okay, I'm placing monies into my 401k because I'm getting a match from my 401k. I'm placing monies into my IRA account because I know that I could go and customize my different investments in there. I make too much money. I cannot place monies into a Roth IRA, so therefore I want to place monies into an IUL on a consistent basis. Another area may be that an individual has lump sum dollars that are just basically sitting on the sidelines. It's sitting in a checking savings account. They've just accumulated a bunch of money into those non-qualified assets, and they want to start putting it to better use. And they read up on, okay, what are some of the most effective ways to grow this money, and an IUL might be suitable for your retirement play. So you're looking to hoard more dollars in there at a quicker route. So not something that you're trying to, extend it out to do contributions for the next 10, 20, 30 years, but you're trying to shove in as much as possible, as quick as possible. Well, then that might result in a 4-pay, a 5-pay, a 7-pay, whatever's most mathematically appropriate. So what you're doing is you're shoving the most amount of dollars in there so that the net amount of risk is getting as small as possible, as quickly as possible, so that all that growth, all the compound interest could grow within this account and give you all those benefits as quickly as possible as well. So that's where funding it and structuring it the right way is crucial when trying to utilize an IUL for some sort of retirement play, retirement planning need. Number 5 most common mistake is not having proper implementation. And what I mean by that is there's a whole multitude of different ways on how an IUL and the cash value, and you have hundreds and hundreds of different offers available through different insurance companies, but it's making sure that you're finding out the correct solution. You're finding the correct product, the correct carrier, all these different aspects. They all have to line up to what is your goal. If your goal does not entail leveraging an IUL and leveraging tax-free growth, tax-free income, having a portion of tax-free death benefit getting left over to your loved ones, if those different things are not important to you, then you should not be leveraging an IUL. There's a lot of confusion out there. There's a lot of smoke and mirrors out there. You have to be very prepared on what would be the best case scenario, what would be the best carrier to use, the best product to use, and all these different things to make sure that you're avoiding these 5 most common mistakes. We try to make things very simple for individuals. If you're interested in speaking with a specialist and you want to find out more details regarding your situation, really figuring out what your retirement goal may be, what the math is behind it, so that you could back up into one of these plans and figure out, okay, if I place X amount of dollars per month or per year, or I'm utilizing these lump sum dollars, is an IUL right for me? Is an IUL right for my retirement? Feel free to either give our 1-800 number a call, 1-800-566-1002, or I'm going to have a direct calendar link in the description of this video. So we're trying to make things very easy for you guys. You could just click on that link and then you could schedule an appointment. We're offering a 20-minute free consultation for anybody leveraging that link for this, that's referencing this YouTube video. And, we'll basically walk you through the different things. And at the end of the day, after our conversation, either with myself or one of my advisors, if it's not a fit, we're going to tell you, IUL, you should not get set up with an IUL plan. If it is a fit, we're going to show you what are some of the best carriers, what are some of the best results that came back, and how it could be something that's favorable for your specific position, putting you in a much better mathematical situation. I want to thank you very much for watching this video. Make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.